Joining us now to talk more about the market day is Michael Zinn. He is Senior Portfolio Manager at UBS Financial Services. Dan Nathan, Principal at Risk Reversal Advisors, also still with us. Michael, today, not a good day to Sarah's point. Big drops, but the best week since
June for the Dow.
Since June for the Dow. Why this sudden strength?
To me, sudden strength is more about the market wanted a dip. Sentiment was overeager. We got a little bit of a reset. And I think that really the big explanation is what has been continuing to work, which is the NASDAQ 100 type stocks. The big, consistent giants that we've basically have kind of seen as leadership for a very long time. They're both quality and they're defense. They're actually perceived as being these battleships that are not really going to be influenced by a lot of what's going on. So I think it's understandable to have a bit of a loss of nerve ahead of a weekend when you have a lot of this kind of open-ended. We don't know how slow things are going to get.
You know, Dan, if you go back, and we've done this before, we don't have it ready right now, but if you track the Fed's balance sheet with the equity markets, starting in October, they started doing that $60 billion or whatever a week repo program. That's QE. I mean, they could say don't call it that. The Fed's had our back. That's the wind in our sails, if you will. Insert metaphor here. Nothing has changed.
Well, it's funny. You know, the Fed chair called that a mid-cycle adjustment with those 3 rate cuts.
They adjusted the market up about 15%.
Well, that's right. They fixed the yield curve. They adjusted the market. They knew what it was going to do to risk assets. I mean, but now just I think what changed this week is that China got in the game. I mean, that's really what they did to stem what was a 10% decline after being closed for a week in their own stock market. So, you know, incrementally, I would just say the reasons that took the stock market down last week, I don't think we've had much of a change in the actual reasons. We're seeing more quarantines. We're seeing more disruption to business activity. So at the end of the day, your guess is as good as mine, but we're back near the all-time highs.
I won't deny that liquidity plays a big role in this and central bank action. But, Mike, the fundamentals of the U.S. economy were actually pretty strong this week. Yeah. And not just today's jobs number. We got an expansion of manufacturing. The services number was pretty good. Yeah. Private sector jobs, factory orders.
That's the backstop of this whole thing. And by the way, that same moment when the Fed started adding liquidity to kind of tame the repo flare-ups was exactly when the majority of countries started seeing their ISMs bottom. I mean, the global fundamentals bottomed at that moment. And we also got the first stirrings of a trade deal. So, yes, I do think the market was a little bit hopeful in trying to price in that recovery. The big question now is, have we gotten ahead of it?
Right. So correlation is not causation, I'm told, Mike. So did global central banks turn things around, or did they literally just get so lucky that they sort of timed it right as we were naturally bottoming anyway? So it's like a double whammy on the equity market.
I think honestly, the Fed repo operations are mostly a red herring. But the idea that the Fed is going to tamp down any dislocations is a good psychological backdrop.
Michael Zinn, weigh in here. Is the market getting ahead of itself on the upside, given the still big uncertainty going on with coronavirus and the Chinese economy?
Yeah, good question. I mean, I think the acknowledgement this week, I think, is the market's incredibly resilient. So I think you can have a good deal of confidence that there's not necessarily a ton of downside. You know, inside of a 5% strong dip, the market got bought. As we talked about, the tech has just continued to lead the pack. People have a lot of conviction in that trade. What's the upside from here? That, I think, is the remaining question, because you've got a valuation question. You've got a Fed that is no longer adding aggressively to the balance sheet, so I think that trade is kind of over. And you have, questions about durability of European growth, as we saw from German industrial production today. So I think that investors can have conviction to buy the dips, knowing that there's some upside, but they'll be dip buyers as opposed to plowing in just at current levels.